Hello and welcome to On the Rocks. I'm Jess, Prospector's Head of New Media. Thank you so much for tuning in to listen to today's episode. On this masterclass episode, we're digging deep into the fascinating world of mining royalties with Sam Siebenaler, co-founder and CEO of Precision Mineral Accounting. With 20 years of industry experience spanning mine operations, exploration geology, and corporate development, Sam brings unique expertise in financial transparency and royalty management. During his decade with Newmont Mining Company, he oversaw mine production and royalty accounting, giving him firsthand knowledge of the complex challenges royalty holders face. In this conversation, Emily and Sam explore what royalties actually are, how they work, common pitfalls in royalty agreements, and why transparency matters in this often overlooked aspect of the mining industry. So grab your drink of choice and join us for an enlightening masterclass on mining royalties with Sam. Let's dig in.
All right, Sam, welcome to On the Rocks. I can't believe it's taken this long to get you on here.
Yeah, thank you. I'm glad to be here.
Yeah, we're really excited about it, and especially with our masterclass series, I'm really excited to dive into a topic that, we covered in some of our earliest On the Rocks episodes when talking about royalty and streaming companies. Like, what were they? Because it was kind of like, gosh, it feels like forever ago now, but like back in 2020, there were a few of them that just kind of started at that time. But we haven't dug in deep on royalties themselves. And with your new company and your new team, like really excited to share with our listeners, a masterclass on royalties and royalty payments and how they work. So I hope everybody's ready.
Yeah, it'll be interesting. Like masterclass is an interesting kind of concept because with royalties, there is still a little bit of each contract is their own unique unicorn. They're one of ones, much like and it makes sense. You're dealing with a one of one deposit, right? So it's interesting that on one hand you're talking about like a masterclass, but it's also very similar to geology in the sense that there are things where two contracts may have similarities and they may have great differences. It's one of the interesting things about talking about them, right? Is we almost have to generalize to some extent.
Sure. Yeah, I always tell people it's like you put four geologists in a room, you're going to get four opinions about a deposit, right?
Yeah.
Getting to consensus can be a fun process. Well, to kick it off then, since this is a masterclass / 101 type episode, why don't you give us your answer to what is a royalty?
Yeah, I mean, so the way I think of it is, and allow me to be wax philosophical for a second, but it's the age-old problem of who gets to how do we distribute the spoils of discovery, right? That discovery and exploration is such a high-risk endeavor that has long odds, but when one comes through and there's this great value that's created, how do we equal it? How do we fairly, and fair is a very loaded word, distribute the income that comes from that, the value, right? So, is it the landholder who's got the minerals on it? Is it the geologist whose brilliant idea found that discovery? Is it the investors that backed that geologist and their idea and are looking for a return? Is it the company that later purchases it and takes on the liabilities and risks of mining it, right? There's many parties involved that would have a claim to, I deserve a chunk of the value, and a royalty is one way of looking at tackling how we distribute and how we split that pie, right? I mean,
and it's different than owning the asset, right? Like it's a share of the production essentially, or the benefits of the production, as opposed to owning the company or owning the asset itself. Is that?
Yeah, correct.
Yeah.
It's a percentage of the produced metal that comes from realizing the value of bringing that discovery to the marketplace. Whatever commodity you were talking about. If you mined and extracted copper and sold it for a profit, who gets what percentage of that revenue, and who does it go to?
And just because some folks may not be familiar with another term that sometimes gets lumped in, what is the difference then between a royalty and a stream or a streaming deal?
Yeah, streaming deals are they're very similar to royalties. They're also a little bit of a futures contract. royalty streams typically are created when a mining company is looking to finance to raise capital in a way that isn't dilutive, in a way that doesn't put debt on their sheets, and so they'll sell future production in a sense in a stream. So, let's say it's 10% of the ounces that the mine produce, the streaming company gets to purchase at a set price that's usually well below the commodity price. So if we're talking about gold and it's $3,000 an ounce right now, roughly, you have a contract that allows you to purchase 10% of the ounces that the mine produces at a cost of 25% of spot, or maybe it's $400 an ounce. So that gives the streaming company the delta, or the difference between what they were purchasing it at and the market price, as revenue.
But a stream is actually accessing the product of production versus a royalty is a percentage of the profit from selling that product.
In some cases, and the thing about royalties is it depends on how you structure the contract, right? It might be a percentage of the profit. It might I think classically people think of like NSRs, a net smelter return, which is a portion of the money that's generated at the smelter. And typically NSRs are an interesting case in of themselves because it says the mining company gets to deduct some costs. Alternatively, you could have like a gross smelter return where they're not deducting any costs, or you could have something that's strictly on the profit to where the mining company gets to deduct all the costs.
Everything. Okay. Yeah. So lots of, like you said, different options on how it all goes. Yeah.
It's a little different in terms of what percentage do you get paid? When do you get paid? How are you going to calculate what you should get paid? In terms, what are we allowed to write off and not write off? And you, the accounting side, the write-offs end up becoming a part where audits become crucially important, because then you start looking at like what costs can the companies write off, and is it a valid cost, right? So if you're looking at revenue for a mine in Nevada, and that mine is owned by a corporate entity somewhere else in the world, and that corporate entity has marketing expenses, what percentage of the marketing expenses can we attribute to the mine, or how much of that is corporate marketing, things like that, right?
Yeah, like the G&A or the overhead associated with it as well. Yeah.
Yeah, and like when do we attribute that to the mine versus the company itself? Yeah.
Yeah. And you kind of rattled off when we were talking about what is a royalty, the different types of people or groups that might hold a royalty. But like, how does somebody end up with one? Like how does this kind of stuff tend to happen?
Yeah.
How do people find themselves in this mess? No.
Yeah. Well, I guess there's a couple ways to answer it. I tend to think of like the philosophical, like life cycle of mining. You're like, if I were to just do a general case, the landowner probably comes into a royalty when a junior exploration company comes to them and wants to do a deal to explore their land, right? So the juniors may be consolidating the larger land package, and that's state lands or private properties. And if it's a private property, they're probably coming up with some kind of deal, whether it's lease payments, and it's very typical for there to be a royalty associated with that. And for the exploration companies, those are great because it allows them to not have to pay the landholders a bunch of money up front and during the capital ramp today, and backload the contract so that the landholder is getting a big piece of the upside in the event of discovery. That's how a landholder typically can end up with one. States and governments end up with one, by passing laws, by declaring state lands. And then the streaming companies, then it gets into a capitalization of like, what does the mining company want to do, and how does it want to raise its fund? Does it want to take on debt to build the mine or whatever their capital project is? Do they want to create a new royalty as a stream? And so that's how those streams get formed. But the simplest answer is like, how do you get involved in it? You sign a contract, right?
Right. Yeah.
Yeah.
That says you're owed, this amount for something when it's done.
Yeah, it's a funny thing in the sense of like, I used to issue royalty payments or calculate royalty payments back when I was working for Newmont, so I would frequently talk to royalty holders, and I sometimes got the sense that, and I appreciated it, that we're trying to keep a very charitable and friendly relationship. Like we want to, like we want to be very good friends, but in the back of my head, I was always like, we're paying you money because we're contractually required to. Like no matter how much
Yeah.
I like, I can't pay you more. No matter how much I don't like you, I can't pay you less.
Right. Yeah, and I know some of the other groups that you and I have chatted about that hold royalties too would be like First Nations or Indigenous groups
Yeah,
in a lot of places, right? And also like investors you mentioned earlier too, and those investors could be individuals, they could be family offices, they could be more, it could be a wide range of folks. I mean, I know a lot of the royalty stuff we've seen on some of our documents and Prospector. It's like, it could be dentists, lawyers, doctors, like you said,
sure.
farmers, or just any kind of landholder or investor that helps somebody early on, right? So not necessarily like someone who's in the mining industry
Yeah,
in order to, yeah.
and to be fair, royalties aren't just to mining, right? There are royalties
Mhm.
in oil and gas. There's royalties in IP for music and movies and things of that nature, right? But the interesting thing about mining compared to many other royalty sources is the lag time that I'm
Mm.
assuming your listeners will be aware of. But from the time that exploration company approaches that private landholder to the time that the mine might go into production could be, 10 years, 15 years, 20 years, 25
Mhm.
years. And then let's assume that it's a deep mine with another 8 years of strip on top of it. So maybe you start getting checks, really, it could actually even be the next generation of people
Mm.
who know that their grandpa had a claim or a royalty agreement, or
Right.
certainly dealt with that. In
Yeah.
my time issuing checks, right? They're issuing these kind of calculations. So sometimes there's that lag period can be really, really interesting to where, like, yeah, you are paying a doctor or an attorney or an artist or somebody had nothing to do with mining or doesn't know much about mining.
Mhm. Well, and then they can sell them also, right? Or they can hand over control too. So some
Correct.
groups go out, even like some of the royalty and streaming groups will actually go out and seek out royalty holders in order to kind of consolidate and stuff.
Yeah, and it's another one of the things where mining gets to be a little bit different than some of the other. Generally speaking, if you're getting a royalty on a music and your song goes into the top 100, there's a big spike in your payment, and it's kind of
Mm.
level, flattening out over time. If you're getting a royalty on an oil and gas and they start pumping oil and you're getting a certain percentage, there may be some fluctuation monthly, but it kind of starts, and then every month you're kind of getting a check that's maybe changing a bit
Mm.
here or there. So the field depletes, right? But in mining, if you own 10% of the mine, the mine might be going, and they might not be mining on your piece of property for 2 or 3 years before
Oh.
they get back in, or they mine it this month and they don't mine it for 6 months, just depending on the mine plan of what makes the most sense for optimizing, the shovels and the turnaround time and all of that stuff.
Mm.
That
True, yeah, because like people think of a mine as just one pit or one kind of, but in reality, most of them are multiple kind of projects or pits that operate as one entity. So yeah, I didn't even think about that you could have multiple landholders that, yeah, if they're not mining in that section that year or that quarter, they don't get a
yeah.
payment.
Well, and then it could even get more complicated when you start talking about operational realities like stockpiling. So we might be
Mm.
mining on your property this year, but we stockpile it. We don't process it for 30 years. Life of
Yeah.
it's low grade, so it's going to be the last thing we feed through the mill. So you might,
Mm.
if you're getting an NSR, when you get paid when it hits the smelter, and it's not going to hit the smelter for 30 years, they might mine it all this year, and you don't get paid for quite a while.
Yeah, I'm sure our listeners can now picture, oh, okay, yeah, this can get complicated. So I wonder,
Yeah.
like, to kind of pull back a little bit then, like, what are some questions that royalty holders should ask, before they sign a contract, or that they should ask about the contract that they have? Are there some basic things that they should understand about their contract?
Yeah. At a high level, I would say right off the bat, define.
Mm.
What means what? So like an example that we talked about previously was, your contract might say when you start to get paid when we reach commercial production. Well, define what commercial production means. If you're doing underground exploration and you're drifting through some ore, have you reached production yet, or are you still in exploration? Do they have to pay you in those scenarios, right? So
Yeah.
I often say that in contracts, and due in part because they're created so much earlier than they actually, in many cases, the contract is put in place before the mine is even designed. They
Hmm.
may be getting written up by people that don't have technical backgrounds on the mine site. So there could be, as some of your previous guests have alluded to, there's quite a bit of siloing that occurs in mining. And so
Yeah.
the contract could be written up by somebody that has not a whole lot of understanding of the technical realities of how the mine's going to operate. So I say about that, all that to say is mining royalties are notoriously have a lot of gray areas, like lines that you can
Mm.
interpret 5 or 6 or 10 different ways. So, in terms of what should royalty holders be asking for? Again, go back to define everything. And specifically a question that I would ask is, are we issuing payments on a measured amount of metal produced, or are we issuing payments on an estimated amount of metal
Mm.
produced? So this gets a little bit into commingling, right? To your point, if you only own 10% of the mine, your contract allows them to commingle, they're going to mix your material in with other people's material, right?
Mm.
Back end of the mill, out comes, a 500-pound doré bar. The only way they're going to be able to guess how much of that doré bar belongs to you, and guess or estimate or however you want, it's a mathematical spreadsheet. It's not a
Mhm.
we weigh it and know definitively that this amount came from you and your property, right? So that's a big
Mhm.
question to ask about too. Is I'd ask about commingling, and I would say define, and lastly I would just say get help, like get technical experts.
Mhm.
Obviously, it's very common for there to be attorneys involved, but also technical experts too.
Yeah. And of course, you and then team, right? But that's where, to me, it's amazing to think about because folks sign these so early, like you said, during the exploration process, where in reality, like, so little about the deposit. Forget about, like you said, forget about knowing the mine plan. If you're out there drilling, I mean, you don't even know how much metal you have potentially. Forget about knowing how the mill's going to work and how many different projects you may have. So do the contracts get updated as the project evolves? Like, do they come back and kind of try to like update it with more information, or no, you're like stuck with whatever you signed the first time?
It's very common for contracts to get renegotiated, but to
Hmm.
renegotiate a contract, both sides need to agree.
Hmm.
So typically, it's another sort of like, again, I speak in generalities because everyone's sort of its own unique situation, but in general speaking, that junior exploration company that was locking up that very first royalty contract typically may or may not have somebody that's worked in production, and the vast
Hmm.
majority of production geologists and engineers don't necessarily touch on the royalty piece, so that it's fairly unlikely that they have somebody that's thinking about that in terms, but also
Yeah.
they're incentivized to write a contract. Most juniors are looking to offload that property in the event they make a
Right.
discovery producer, and so they're looking to write a contract that isn't going to create a roadblock to being acquired or to selling, right?
Hmm.
So sometimes you're talking about NSR percentages, like juniors will be wary to go above a certain NSR percentage or a certain royalty percentage, mostly because they're concerned that it will scare away potential buyers, or that
Yeah.
a little bit of the insider baseball of like, well, I'm pretty sure the producers don't like above 3%, so I'm very leery to go for it. Or it might be a 5% with a 2% buy down, so that we can get 3% to where I think I can sell it. So
And that's
there's
so important that,
yeah.
yeah, then the folks on the other side need to know that, like, the group that you're negotiating this royalty agreement with at the exploration stage, that is really most likely not going to be the company that you're dealing with once it starts to produce, if the mine ever goes into production, right? I mean, like, very rarely does a junior type team take a project all the way through, exploration, development, construction into production. It's going to be sold to somebody else. So your contract has to be written in such a way that you understand when the other party changes, like what that means.
Yeah, and I guess that's the other piece of advice that seems simple, but get it all in writing. And if that makes the
Mhm.
contracts longer, then it makes the contracts longer. And some people think, well, that just means I'm going to pay the attorney more, and nobody
Yeah.
that's having to spend money that they don't want to have to spend. But if your royalty contract is going to dictate how you distribute hundreds of millions of dollars, get it get it all in writing. And also to the lag time that we're speaking to. just because you had a great relationship with the person that you inked the contract with, 3 years later they might get promoted, or they might get,
Hmm.
or they might just decide they want to get out of mining. And certainly by 10 years, 15 years later, you're not dealing with the same person. So handshake deals, that, the handshake might be in a completely different industry doing a completely different thing, and you're dealing with someone else.
Yeah, absolutely. Well, are there any other like commonly overlooked elements in royalty agreements that really affect the payments that people receive down the road?
Yeah, we touched on it a little bit, but I would say commingling is a really, really big one.
Hmm.
Um, it's again, it's that ability to blend your material with other people's material. It makes how you're going to get paid and how we're going to be able to calculate how you get paid a lot more complicated. But it also unlocks a ton of value to the mine company, right? So
Mm.
somewhat famously inside the industry, there is a mine in Nevada in Carlin that one of their royalty holders that owned a large portion of the pit did not allow them to commingle. And so that mine has a completely separate leach pad just for
Mm.
their material, and then a leach pad for everybody else's material. And when they run it through the mill, you can only run that person stuck through the mill at that time. And then, you can't blend it to optimize recoveries, or if it's
Mm.
chunky or clay, you can't blend it with other people's stuff to try to get it through the correct, like all these other operational like levers that the mine gets to
Hmm.
pull, they don't get to pull. Trust me, no
Yeah.
mine wants to have 10 different royalty pads for 10 different royalty holders, right?
Yeah.
So the commingling agreement is one of those things that's very valuable to them
Mm.
and potentially detrimental to you. It can
Mm.
impact your payments. It certainly makes it a lot less clean to know that everything that came off of your leach pad is yours, and then we just measure it, and now there is no dispute. That was the amount, right? So I
Yeah.
mean, that's the other sort of caveat to think about is like, if you're when you're negotiating these contracts, understand that commingling has a value, an intrinsic value that is a bit of a leverage point if it isn't already in your contract. But also, what you're starting to see more now with as the streaming companies have come online, and they're starting to work in commingling plans, which is more along the lines of like, how are you going to tackle, if you're going to commingle, it's going to create all these issues. How do we want to tackle that?
Mm.
And that whole separate document that dictates how we track the commingling kind of thing.
No, that's such great advice, because I think it's one of those things where if folks are sitting there and have a royalty, or like just understanding that language and what it really means in the operations and how it impacts payments, and also the value of the project, because I also think you know, ultimately, a royalty holder should be really invested in the success of the mine and the company that owns the mine, right? Because if the project's not successful, or the mine's not, productive and profitable, the company isn't, and then your royalty goes to nothing because it goes out of business, right? So it's like that balance between, you don't want to have something that is extremely beneficial for you, where you have your own leach pad, if it creates so many issues for the mine and the owner that in general it puts a project at risk, right? You're in this kind of balance of benefit and mutual kind of reliance on optimizing the operations.
Yeah, and absolutely right. Like it's the age old. I mean, and you'll hear this in negotiations quite a bit. Of do you want 5% of something or zero
Hmm.
percent of nothing, or 50% of nothing, right? Like, so
Yeah.
you want the mine to continue producing, because if it's not producing, you're not receiving payments. And at the same time, what is an equitable split? And when we're starting to talk about like what percentages can work, um, that's a place where mining companies are able to operate with a serious knowledge imbalance of they've reviewed thousands of royalty contracts, and in many cases they're negotiating with people that outside of maybe streaming companies have maybe never even seen one, right?
Hmm.
So what can work and what can't work, or where can we give and take? But the goal is not to get into an adversarial relationship. Of course, there is still a level of like mutual work together that you want to have in order to continue getting payments in the long term.
And other than the commingling potential issue, or just topic that folks should be aware of, are there other things that make a clean royalty deal versus a messy one, or are there signs kind of early in the project's life that tells you, oh, you're headed for some complexity here? when as
Yeah,
you're looking at it?
I was alluding, and we've kind of touched on it or we've brushed against it. The, for the streaming companies, they're typically, when you're creating a streaming deal and it's a capitalization, that's usually occurring much later in the process. So
Mhm.
if the company's trying to raise money for their mill or to build the mine, well, then they already have a pretty clear idea of what the mine and the recovery is going to look like, what the processing is going to look like. And so you're
Mhm.
up from a position of much more knowledge. And so those tend to be cleaner in the sense that streaming companies have in-house expertise and they're operating from a position of more knowledge in terms of how the thing's actually going to operate. For the earlier agreements, I guess, um, again, it's sort of a balancing act, and this gets to be a little bit of a tricky one too. Of like, so many of these projects don't ultimately move forward.
Right.
For every one lease deal that you do that finds that tier one discovery, there's several hundred lease deals that ultimately there was nothing there. And so it does
Mhm.
come down to how much money do you want to spend writing a lengthy, detailed contract on something that's still kind of conceptual, and that gets to be a little bit a personal risk decision that I would say the person has to make on their own.
Absolutely. Well, I wonder, can you give us like an example where a group was significantly underpaid and kind of how that was determined or how it was figured out? And of course, you don't need to like name people or companies, but like how does it work like when you go in and you do an audit and like how do you figure out that someone's been underpaid?
Yeah, I mean, so audits kind of take two different forms. There's the financial piece of the contract. So like, let's say, and this again comes down to terms. Let's say your contract says the metal price was going to be the metal price of the London Metal Exchange on the last day of the month. So one thing we might do is that the metal price that got applied to the payments, right? Like
Mhm.
that's the bookkeeping piece of, you recorded 1,000 ounces of production, and you, across the board, did you report that publicly in your disclosures and things of that nature? So there's the paper side of it, but then there's also the technical side, and to some extent, and this gets into another good point of, you're only going to be able to audit the information that you have available. And so I guess that's what we put into our contracts. Get the audit clause in there that you have the right to audit, and the information
Mm.
you're going to need, that spell out the information that you want access to, the monthly reports, the reconciliation
Right.
reports, um, up to and including, it's very common to ask for information just on your claims or your land package or your holdings, but the mine using data from outside of your mine holdings to determine, to come up with a variograph and a resource model, and that's going to impact your payments. So sometimes you might need to, and it's a bit of a negotiation point, but you might want to ask for information outside of your claims if ultimately that
Mhm.
information is being used in a way that impacts your payments. So I get, to some extent, the answer is, um, there's some people you can't help if the contract's been written to where they get in no information and they don't have a right to audit. Well, then there's no audit
Mm.
to do, right?
Right.
We're going to make sure you put it in there.
And that's where when you go in and they do have the right to audit, you're asking for all that information, but you're comparing then like how you would calculate the
Yep.
payment due according to the contract compared to how much money they actually got paid, right? You like look back at the payments they've received and reconcile it.
Yeah, and what I've seen a lot of times is, again, the best analogy for royalties that I've been able to come up with is a little bit like how we pay taxes, in the sense
Mm.
that if the government that's collecting taxes is the royalty holder and the taxpayer is the mining company, it's similar in the sense that you look at the tax code and you calculate
Mhm.
what you owe in taxes, and you report that to the government, and the government either accepts your tax return,
Mhm.
they audit you, right? It's very similar. So if you're a royalty holder that's just cashing checks, that doesn't mean that they've
Mhm.
interpreted the contract, but however they've decided to interpret it, right or wrong, if you're just cashing the check and not asking questions, you're co-signing on that it was right, right?
Mhm.
It, if it was wrong, you would dispute it, right? So part of
Right.
it part of it is what, when I go through and we're looking at like the technical data that's being given to us on an audit, a lot of times it isn't necessarily that, hey, the way you calculated is wrong. It's more, we could have also calculated it this way or this other way or this other way. And of course, you've chosen the way that's most beneficial to you. That doesn't mean there isn't a conversation to be had about the other ways that we could. I mean, realistically, it's like, you want to calculate the way that's best for you. I want to calculate it the way that's best for me. Like, now let's have a conversation about how we're going to agree that we calculate it from here on out.
Yeah. And do you ever see cases where the company overpays?
Oh yeah.
Really?
Yeah.
Yeah.
Oh sure. I mean, and I know of companies that, sometimes the answer is, well, we don't quite, some companies approach that as like, well, if we could calculate it 3 different ways, let's do it the way that's best to them. And then that way, there's no, like, especially if it's like, if it's the difference between paying you $10,000 and $12,000, well, let's just give you $12,000 and mitigate the liability. Right.
Right. Yeah.
But sometimes companies will take that approach.
Interesting. And what about, like, in the errors that you do see, are there patterns? Like, are there consistent reporting mistakes, or different regions or places perhaps where enforcement or the kind of rules of royalty payments aren't enforced as strongly?
I mean, one of the most consistent underlying issues is, and this is another thing that I find super fascinating about mining, is if you think of all the due diligence and the regulation and the structure that goes into how well do we need to know the resource before we mine it, right? So the resource model and declared reserves and the 43-101s and the exchanges and all of the work and due diligence into making sure that number is correct. But then once it's produced, there isn't really nearly that much, and there isn't that, and it kind of comes down to, what are you measuring is what you pay attention to. So I would say if there's one common thread, it's that, even in the biggest mining organizations, there's only a handful of people that are working on, are the royalties correct at any given time. It might be one person on a mine site. Maybe it's 2 if there's a financial controller and like a metallurgist, right? And so then you're dealing with things like, the drift, the knowledge gap of, this is an ancillary duty. The chief metallurgist's whole job is not make sure your royalty payment is correct. It's maybe something he or she is spending, a couple of hours a month on. And if, I kind of also go back to the squeaky wheel. If you're not auditing or disputing anything, or at least asking questions, and nobody is either, what's that person has a boss that has 10 other things the boss is interested in that aren't your royalty. And so if you're not interested in your payment being right, what's the chances it's top of mind for them?
Right.
Yeah. So it's a lot of human factor, right? It's the, we didn't know, or it wasn't a priority, or, who knows if they've even read the contract. There's certainly, the short-term mine engineer is not worried about the royalty contracts on the property 99% of the time. Right.
Yeah. No, that's so true. It's like, it's for folks that hold a royalty, it's not as important to anybody else more than it is to you. Right.
Yeah.
Like, that's for sure.
Yeah.
Yeah. Well, how often are the royalty payments contested? Or like, how often do people push back? Did you see it as pretty common before, or?
I didn't. And, and it's not that we weren't audited, right?
Right.
But I can't think of an instance where there's dispute. Now, that said, in my personal background, it certainly occurs. Like, there are things you can even Google of contested cases of disputes, and I would say, again, kind of in part to the streaming companies that are much more watching this more than mining companies have been. You're starting to see more and more litigation and more disputes pop up over issues.
Yes, it's like, what about like government bodies? I would think, because I can't imagine there's a ton of capacity internal to the government agencies that receive the royalty payments.
Yeah, and that's a great point too. On the government side, call it royalties, call it a tax based on mine production, and certainly people have thoughts and feelings about whether royalties even exist on the government side or if it is all taxes. But regardless of how you get there, Yeah, in many cases on the government side, there very well could be laws or regulations in place that you know that require a certain amount of auditing to occur.
Hmm.
It comes down to are the agencies that are tasked with doing that correctly funded? But certainly, I'm aware of states, governments, territories that are behind on their required audits. Um, that certainly occurs. There's a certain point. Again, it becomes a staffing issue and a capacity issue.
Sure. Now, are there key numbers that like if you saw it in a royalty agreement, you'd be like, whoa, like there's no way. Like, is there like a standard range for that stuff?
No, I mean, to
No.
me, well, I don't, I mean, define standard. I mean, I think it's a game of tug of war where the producer wants that number to be as small as possible and the royalty
Hmm.
receiver to be as big as possible. And so it really, and I guess we haven't really touched on it, but I can't allude to enough that the contracts are all unique.
Hmm.
It's a roundabout answer to your question, but I once saw a royalty contract where clearly one of the people that was drafting it had sent a email or a letter to the lab on site of the mine saying, what's your process for determining assays? And the labs had
Hmm.
sent back clearly an SOP. So in the royalty contract was like this 33-step process of exactly how the samples are going to get handled, to include, and this was my favorite line, that was like 10 pounds of material gets put into the Cashman 3200 like cement mixer and mixed for 5. And it's like, so now the minute you switch cement mixers, your contract is out of compliance, right? Like, but
Right.
somebody that was important enough to put into the royalty contract. That's how we want it done. We want that cement mixer.
Fascinating. Yeah, you must see all sorts of quirky stuff. So how do you, I mean, especially with what you all are doing, like how do you see all of this starting to change? Are you seeing new processes, new technology like smart contracts or like do you see things starting to change in this space?
I hope so. I mean that's
Mhm.
certainly part of why we founded Precision PMA, to help make some of these changes. In my mind, it's sort of a broader conversation about transparency in the industry.
Mm.
If you were the investor that bought into it, you know, invested your money with the intent of getting a return on a mining operation, but it's really difficult for you to know if the payment is correct or to
Mhm.
understand what the mine is doing on a day to day. And mine sites tend to operate like little miniature fortresses in many extent. I mean, up to and
Mhm.
including fence, right?
Yeah.
So, how do we create something for the industry that allows to where you don't have to spend 20 years in mining to know that you're getting paid correctly? That kind of transparency brings trust, and I think that trust
Mhm.
helps money into the industry in a way that the industry, everybody kind of acknowledges that, how are we going to fund exploration if nobody wants to take the risk? Well, I'm not I'm not saying that this is the solution to that whole problem, but maybe in a small way, helping people understand that there is a way to get, to call balls and strikes on right and wrong. And this is you are getting paid a correct amount without having to get a whole career. Hopefully that
Yeah.
helps.
Yeah, I mean, I think absolutely that most folks probably assume that by the time a mine goes into production, it's most likely going to be owned by like a publicly traded company. And at
Mhm.
that point, they have to follow all these rules and they're going to be really good at compliance and they don't want to get in trouble. So I can just trust that they're sending me the right amount of money. Like
Yeah.
I think like I really do. And it's like, if like you gave me some information the other day, please share with the listeners on like how like it could be a pretty wide ranging error bar on some of that, even with
Yeah.
larger operations.
Yeah. I mean, like on the technical side, when we start looking at like mine to mill reconciliation, which is really reconciliation is just a fancy word for what did we think was going to happen versus what did
Hmm.
happen. So like you start looking at the resource model that was published versus the ore control model, which has more data and should be better. How did that compare? And then the ore control model for what we think we mined and shipped to the mill versus when we ran it through the mill, what do we think we produced? So you're looking at like the ore, like what we think we shipped versus what we did produce. And in many cases, like the industry standard I don't know that there is one, but you're shooting for, call it plus or minus 5 to 10% in gold, maybe plus or minus 3 to 5% in base metals.
Mm-hmm.
But the more nuggety the deposit, especially like in gold deposits where grades can vary wildly, you can see plus or minus 5%. And that's assuming, that's an industry benchmark. That's assuming something hasn't gone horribly wrong, and you can see plus or minus 50% on a month-to-month basis or 60%. Mm-hmm. Usually that's going to get an internal response from the mining company to where they kind of go, whoa. Wrong, right? Like, and they
did someone put a decimal point in the wrong place or what?
Yeah, and they tend to look at it more like on a 3-month or probably more like a 12-month rolling. So like we aggregate it all together, and on a long enough timeline, it does seem to like be less variability, but that variability is there. And again, going back to like, if the month they got it wrong by 60% was the one month they happened to be mining on your stuff.
Yeah. Ouch.
Yeah.
Yeah, that would be my luck. Yeah.
Yeah, totally.
My little package got the 60-month error bar month. But that's where I think, again, I'm so excited for what you guys are doing, because I also agree. I think that for folks that maybe are interested in investing in this space, and non-traditional investors in particular, like there are so many things that they get concerned about. And this is one of those things where, like, with a team of experts that can walk you through it, look at what you already have, if that's the case, and help you address some of these questions on the front end. If it's a new royalty agreement, right? It should really de-risk it, and better communication and better understanding on both sides, right, is always makes for a better deal. Like a more educated royalty holder is better for the company in reality.
Yeah. And I like to say the math formula for disappointment is expectation divided by reality. And in some cases, you're bringing in an expert to help manage your expectations of what it might can look like. And another hand, you're bringing in, an advisor like us to help, was that reality the real reality, right?
Sure. Yeah.
Help manage your disappointment, or on the flip side, your excitement.
Yeah. Well, as you know, as a listener, we end each episode by asking our guests if you could wave a magic wand over the industry and change one thing overnight. And it doesn't have to be related at all to what we talked about today. But what would you love to wake up tomorrow and see changed in the industry?
Oh, I have several answers to that question, but I would say, just based on the wheelhouse of where we are, I would say trust and transparency, but transparency is you take a step back from that. It gets more into how do we communicate to the larger world what we do and where our values lie, and how we operate. I think mining to some extent has been content to hide in the shadows. And I get it too, right? The nail that sticks up the highest is the one that gets the hammer. Like everybody says, like, hey, let's get front and center and start talking to the public, but you want to put your project at risk, your permit at risk, to be the one to lead that charge. So I get it. But so I don't know the answer to that, but I'd say trust and transparency, and part of where we get that is just a better understanding in the larger society about what mining contributes, how we add value to society. It's gonna have to be a pretty big magic wand.
That's why it's magic, Sam. That's why it's not a reality stick. It's a magic wand.
Man, we got like genie with 3 wishes, isn't that?
No. That's a different podcast. Yeah. Oh, awesome. Thank you so much for joining. And of course, like, really excited to follow along with the cool stuff that you all are doing, and appreciate you coming on and educating our listeners a little bit about royalties, and really excited to hear what everybody thinks about the content.
I appreciate it. It's been fun. Thanks for inviting me.
Yeah. Thanks.
Thank you so much for tuning in and listening to this episode of On the Rocks. If you enjoyed this conversation with Sam about mining royalties, be sure to subscribe wherever you get your podcasts. If you're interested in being a guest or sponsoring an episode, we would love to hear from you. Please email us at media@prospectorportal.com for more information. We'll see you next time.